My name is Andrew Stotson. I want to welcome you to this Valuation Masterclass Bootcamp presentation. Students go through an intense 6 weeks of training and teaching and studying and learning and practicing until they end up with a final report. They start at zero. They know nothing about the company. In fact, we don't even reveal the company to them until the second week, the first Monday of the second week out of a total of 6 weeks. So they really have 4 weeks to build this presentation and do the valuation and all of that. It's impressive. So if you want to build a competitive advantage in company valuation, come and join us at the Valuation Masterclass. Well, without further ado, let's bring in our next presenter. PU, how are you today?
I'm fine. What about you?
I'm good. I'm getting a little tired though. I've been up since early in the morning. I guess you're tired because you're the last one going, huh?
No, I'm not tired. I am a bit excited about today's presentation.
That's good. Well, you busted your butt to get to this point. I wonder how many hours you worked on the Valuation Masterclass Bootcamp. Do you remember what you put in your accountability?
Yes, yes, I do remember. It's between 2:20 to 2:30.
Incredible. 6 weeks, 200, more than 200 hours of work and study and learning. What was the most exciting part for you of the whole thing, besides, of course, presenting right now?
Okay, so the main exciting part was to gather all of the information and then brief it up, and then we have to be very chooseful about our words and how we have to present the whole information in a limited kind of word limit and all those sort of things. Like, I am a person who can write 6 pages, but I can't write 2 lines about the same thing. So I can't I didn't had the ability to like brief some brief things and brief information, but now I guess I have that. And yes, that's been really helpful.
You've definitely built that skill, and I think it's time to demonstrate it. So I'm going to bring up your presentation first, and then let's get that up here. And I think we're ready. And so what I'm going to do is take myself out of the show, and then as soon as you see me disappear after I say I'm leaving, then you just take it on and go with it. So good luck. I'm leaving now.
Okay. Hello everyone, my name is Piyu Singla. I initiate coverage on Exxon with a buy recommendation based on a target price of 157 US dollars, implying an upside of 34%. The main reason are growth potential through strategic expansions. I derived my target price from a discounted cash flow based valuation using a WACC of 12.3% and a terminal growth rate of 2%. The main highlights for this presentations are big bet on UK refinery as Europe cuts oil processing, enhanced production capacity with Pioneer acquisition, surge in energy market as Exxon tops LNG production targets. Risks. There are many risks involved in this company since it lies in the energy industry. Oil price volatility due to OPEC quotas and supply disruptions, political uncertainty impacting global business strategy, and many more. Moving on, let's see the company background. ExxonMobil. ExxonMobil Corporation, XOM, formed in 1999, is a global leader in oil and gas industry with a 24% market share. Its operations cover exploration, production, and distribution of oil and natural gas. The company has proven reserves of over 17 billion barrels of oil equivalent. ExxonMobil runs one of the largest chemical businesses globally, producing key products like plastics and synthetic rubber. It has a global network spanning North America, Europe, Asia, and Africa. Exxon has a refining and chemical capacity of 5 million barrels per day and operates 19,103 retail fuel sites. Let's move on to the stories. Big bet on UK refinery as Europe cuts oil processing. Exxon is expanding its refinery in Fawley, which is in UK, with an investment of $1 billion, enhancing its daily crude processing capacity. This expansion addresses UK supply concerns due to Europe's plan to cut oil refining capacity starting in 2025. Originally gasoline focused, Fawley will shift its production towards diesel, jet fuel, and chemicals, reducing UK's diesel imports and increasing petrochemical output. This project includes a new efficient hydrotreater and a hydrogen plant with a daily capacity of 55 million standard cubic feet to support diesel production. An expanded jet fuel pipeline to Heathrow Airport will improve fuel transport capabilities. Increasing diesel production at Fawley should reduce Britain's diesel imports by a quarter, which is about 3 million tons a year. Strategic expansion positions it to meet rising demand, potentially increasing UK's revenue contribution to Exxon from 7 to 12%, amounting to $1 billion by 2028. Enhanced production capacity with Pioneer acquisition. ExxonMobil has completed its acquisition of Pioneer Natural Resources, significantly boosting its Permian Basin operations. The Permian Basin is a major oil producing area in southwestern United States. The combined company now holds 1.4 million net acres in Delaware and Midland basins, with an estimated 16 billion barrels of oil equivalent resource. ExxonMobil's Permian production volume would increase to 1.3 million barrels of oil equivalent per day, that is MOEBD, based on 2023 volumes, and is expected to rise to 2 by 2027. Surge in energy market as Exxon tops LNG production targets. Exxon is ahead of its schedule with its plan to double its LNG portfolio to 40 million tons per annum, that is MTPA, by 2030, focusing on producing its own gas rather than trading third party gas. Originally targeting 40 by 2030, Exxon is now producing 30 and is expected to reach its goal by 2028. Currently, LNG contributes significantly to Exxon's revenue, and this expansion could increase Exxon's revenue share from LNG by 20% to 35% by 2028. Moving on, let's see the industry analysis page. Taking the wider perspective on energy industry, let's see what the industry says. The global energy landscape is shifting towards renewables. Dynamics of the global oil and gas market. In 2023, the United States, Russia, and Saudi Arabia collectively contributed 32 million barrels per day to global oil production. According to the Oil and Gas Market Report for 2023, the global oil and gas market grew from $6 trillion to 7 in 2023. Saudi Aramco leads globally with massive reserves, while Exxon dominates US market. Shell, BP, Total Energies control Europe. Policy shifts and oil market resilience in face of uncertainty. In 2024, oil and gas industry faces significant challenges due to geopolitical tensions and shifting policies. Events in geopolitics have a bigger influence on oil prices. The war in Ukraine caused a 30% increase followed by price declines. Global gas demand is expected to rise to 2% thanks to colder weather and lower prices, but limited LNG production could drive up prices again. New policies such as US Inflation Reduction Act and EU's RE Power EU plan encourage investments in clean energy, but they also create compliance hurdles and slow project approvals. The industry is adapting to those changes to stay resilient and continue growing. Slow shift from fossil fuels to sustainable energy. Greener times are ahead, with reports indicating that solar and power will triple by 2030. While nuclear power is stable, the primary focus for a sustainable planet is renewable energy. The oil demand is still there, even though renewable energy may rise. By 2028, it is expected to reach 110 barrels per day, driven by industries like petrochemicals and aviation. King's Research estimated the market size to be 7 trillion and projected to reach 9 by 2031, growing at a CAGR of 4% from 2024 to 2031. The energy transition is complicated, although the use of renewables is growing, but there is still a need for oil in emerging markets. Moving on, this is the quarterly data on ExxonMobil. In first quarter of 2024, ExxonMobil experienced a slight revenue decrease of 3.9% year on year. The company saw a 21.1% decrease in gross margin and a higher decrease in EBIT margin of 26.3%. Exxon reported first quarter 2024 recurring EPS of US 2 $0.078, which was minus 26.2% year-on-year basis and minus 26.2% quarter-on-quarter basis. Moving on, this is the consensus estimates for the ExxonMobil. Over 60% of analysts recommend buying the stock, while 11 suggest holding it. The mean target price indicates a potential 13.1% upside from current level. Revenue growth is expected to recover with a 5.8% increase in 2024 following a significant 16% decline in 2023. Analysts project a notable rise in gross margin, improving from 25% to 46% in 2026. Furthermore, EBIT is anticipated to remain strong, increasing slightly from 14% to 16% by 2026. Moving on, this is the revenue structure of the company. ExxonMobil's revenue structure is diversified across upstream, downstream, and chemical segments. Upstream segment generates 56% of total revenue. This segment includes oil and gas exploration and production, with key operations in Guyana and Permian Basin. Major projects like Stabroek Block significantly boost production volumes and revenues. This downstream segment contributes 40% of revenue, encompassing refining, logistics, and marketing, with energy products at 32% and specialty products at 8%. The chemical segment makes up 4% of revenue, focusing on petrochemicals and advanced polymers. Geographically speaking, Asia accounted for 37, US 24, Canada 20, Africa 9, and others 10%. ExxonMobil's total refining capacity in 2023 was 5 million barrels per day. The company's diversified revenue structure enhances its stability and market positioning. Moving on, this is the FVMR of our company. FVMR stands for fundamentals, valuation, momentum, and risk. Overall, Exxon appears competitive relative to 1,830 non-financial companies in USA. Fundamentals are valuation are pretty much neutral. Momentum unattractive due to fluctuating revenue and EPS growth despite some recent price improvements. Risk the balance sheet risk is low with improved liquidity and reduced leverage, while price risk measured by beta remains stable and low. This is the WCB. Exxon's profitable growth consistently ranked slightly above among average among 320 large energy companies worldwide, improving from 6 in 2020 to 4 in the past 12-month period. Revenue growth fluctuated from 7 to 4 in 2022, stabilizing around a low 8 in the past 12 months. Expense direction remained constant, moving from 6 to 8. This is the P&L statement of the company. We can see that revenue has been volatile with significant growth from 2021 to 2022, followed by a decline in 2023. Forecast indicates a steady increase in revenue, which is driven by increased production capacity and favorable market condition. EBIT shows a similar trend. Moving on, we come to the asset section of the balance sheet. Total assets are projected to increase significantly by 2028, which highlights companies' continued investment in long-term assets and increasing liquidity. Let's move on to the liabilities and equities. Total liabilities are projected to rise significantly by 2028. Moving on, this is the cash flow statement of the company. Operating cash flow is expected to recover by 2028, indicating a strong turnaround in the company's cash generating ability over the forecast period. Now, these are the ratios. Gross profit margin is projected to remain stable, indicating consistent profitability. The debt to equity ratio is also expected to stay low at 0.2, reflecting strong balance sheet with minimal reliance on debt financing. These are the ratios continued. Net profit margin is expected to stabilize around 7.9 to 8.1% from 2024 to 2026, reflecting consistent profitability despite potential market fluctuations. Moving on, this is the free cash flow data. The free cash flow or FCF to firm and FCF to equity are projected to grow steadily, indicating strong cash generation capabilities. This growth is further reflected in increasing FCF per share. Moving on, this is the relative valuation of the company. On the forward 2025 multiple, ExxonMobil looks fairly valued compared to energy sector in the US. The disparity between Exxon ExxonMobil Asia and the global market highlights that Exxon is overvalued. I forecast its return on equity to be around 14% in 2025, lower than the sector average in USA and the global average, but still higher than the sector average in Asia. This results in ExxonMobil trading at a premium based on 2025 PB to ROE multiple. Moving on, I expect its EPS growth to be positive in 2025, improving by 8.3% as net margin stabilizes after the significant fluctuations in previous years. Therefore, using 2025 PEG ratio to value Exxon provides a meaningful analysis but highlights that the company is overvalued relative to its peers. These are the main assumptions of my presentation. I assume a risk-free rate of 4% and a market equity risk premium for US market of 10%. ExxonMobil has relatively low beta, so I assume a beta of 1. I forecast a capital structure with around 15% debt to total capital. This results in WACC and a discount rate of 12.3%. I use a terminal growth rate of 2% and free cash flow to firm, that is FCFF, to value ExxonMobil. In my base case scenario, I anticipate moderate sales growth leading to a value of 157 per share based on FCFF methodology. This represents a 33% upside compared to current market price. Let's move to the sensitivity analysis. Okay, so if our revenue or sales will rise by 10%, then the value of the share will be 159, and if it is decreased by 10% in pessimistic case, then it will lead to 156 value. These are the main risks in my company. Oil price volatility due to OPEC quotas and supply disruptions. Oil and gas industry is fundamentally a commodity business. ExxonMobil's operation and earning are significantly affected by fluctuations in oil, gas, and petrochemical prices. These prices are influenced by local, regional, and global events or conditions, including economic growth rates, new supply sources, OPEC quotas, supply disruptions, weather patterns, and technological advances. Moving on, moving on to the other risk, political uncertainty impacting global business strategy. Political instability in key regions can disrupt Exxon's global operation. Factors such as government policy changes, expropriation of assets, regulatory developments can pose significant risks. Energy challenges and volatile economic climate. Global economic conditions, including recessions, change in population growth rates, civil unrest, government regulation, trade tariffs, and currency exchange rate fluctuations, can significantly impact the demand for energy and petrochemicals. Government intervention and regulations in energy market. Operating in diverse environments, Exxon must manage regulatory risks, including government delays, penalties, and policy changes. Environmental and safety risks require continuous assessment and mitigation through environmental assessments, community consultations, stringent safety standards. Additionally, reputational risk from operational incidents, cybersecurity disruptions, and perceived insufficient progress in energy transition can hinder companies' ability to compete, secure approvals, and attract talent. So, here my presentation ends. Thank you so much, everyone, for your valuable time.
Excellent. All right, let's go through this a little bit. Um, Here's a couple different questions. The first one comes in: Exxon valuation is significantly higher than its peers, indicating potential overvaluation. How can your premium valuation be justified?
Okay. So, firstly, Exxon's strategic focus on long term investments in high growth areas such as LNG and renewable energy positions it for sustained future growth. And also, the company focuses its investment on traditional as well as new renewable projects. So, that is why I think the higher valuation is justified.
And if I look at the weighted average cost of capital, I'd say it's even a little bit high. And if you were to bring that down, you'd have even more upside. I'm just curious, how do you feel about your 33% upside? Is that
Okay.
solid, or do you feel like it could be going up or down, or what?
Okay, so I think this is pretty much solid. If it will be upward a bit higher, like 35%, 36%, then it will be okay. But a 40% or 50% increase doesn't seem reasonable to me. And same thing with the downward. In the pessimistic case, it can play around 5 to 6%, but not greater than that.
Okay. And how about, what do you think is the reason for the difference between yours and consensus recommendations, and maybe just your view in general versus consensus?
Okay, so there has been a significant difference in consensus estimates and my estimate. That is mainly because I believe that company will be able to reduce its operational costs, which the company has previously been able to do so, and it will do more of it in future. And the second thing is that they will be able to expand their production capacities, and they are their major focus is that only. So that is why the difference between my estimate and consensus estimates is there.
All right. Hold on one second. How does it feel to graduate from the Valuation Masterclass Boot Camp?
I it feels like I am on cloud nine. So honestly, in the first week, after I saw all those DORs, I was a bit terrified. Like, will I be able to make it or not? Since my college have reopened and I have to devote my time there as well. But since I have made it this far under your guidance and with the support of the valuable A Stores committee, so I feel pretty grateful, and thank you for providing me this opportunity. I have learned a lot, and by a lot, I mean it has been a great journey.
And what would you say is something that you feel confident about, or something that you gain that you didn't have when you came?
Okay, so earlier when I used to look at the annual reports of the company, I used to feel a bit lost here and there, like so much data, 200 pages report, 115 pages or so much. Nobody has that time to read and to analyze what are the causes or reasons behind that. But after coming here, I have got this ability, so I can put a lens in the annual reports. I can pretty much analyze what are the potential causes of some fluctuations here and there, and how the company will behave in future. So that is one thing that I have learned and is most valuable to me.
I remember many years ago when banks in Thailand started upgrading after the crisis, and their annual reports were like 250 pages with all kinds of footnotes that I didn't see before the financial crisis of 1997. And then I remember someone came from, I don't remember, it was World Bank or IMF, and he was complaining about the disclosure. I said, and I brought one of the annual reports out with like 250 pages. I said, if you think there's not enough disclosure, then you're not reading this document.
Yes.
And I think one of the lessons that I learned was that there's so much in the annual report, so much is there. And a lot of analysts waste time, going to visit a company, for instance, and they didn't even really understand what's in the annual report. So I'm glad to hear that.
Yes.
Awesome. All right. Well, now it's time to relax and enjoy the rest of the evening. I know I'm going to. And so, congratulations. And I'll see you in the Slack channel. I'll see you on our graduation ceremony.
See you there. Thank you very much.
You are welcome. Well done. Again, another great presentation. So impressed by what everybody's doing right now. Remember, these guys go from zero in just 6 weeks. They've got a full report that they're presenting. So obviously, they came in and they were nervous. They were scared. They didn't think that they had what was necessary, or they didn't have the background. But as you've seen, we can take all kinds of backgrounds. It doesn't have to be a finance background. We've had students that are engineers and medical doctors even. So if you want to build a competitive advantage in company valuation, why not come and join us at valuationmasterclass.com/bootcamp.